All right. Strategy number 4 is actually how do you use corporate earnings to buy properties without paying marginal taxes? Slide number 1, I basically described how you can technically open your own corporation, and from the corporation, you will now be getting checks and your income will be there. When the time comes, if you want to buy the property and you need to withdraw a significant amount of money from your corporation, you are technically on the hook for taxes because first, if it stays in the corporation, you pay 12.2%, but the day you withdraw the corporation money, you have to pay personal taxes. That's why when we incorporate, we tell the customer that, you should be withdrawing only, let's say, 40, 50, $60,000 every year rather than $120,000 worth of income from your corporation to minimize your taxes. So let's assume you're in a situation where you earned $300,000 worth of income in your corporation. You only withdrew $60,000, but now you're buying a property and you need to withdraw the remainder of the $240,000 that is sitting inside your corporation. How can you do it without paying the marginal tax of 53%? Because if I were to withdraw the entire $300,000 from the corporation to myself, I'll be paying personal taxes, which is far higher, which will be 53%. If I keep it in the corporation, I enjoy 12.2% taxes, which is only up until $500,000 of income. If I withdraw 53%, if I am over $200,000 of income. So most of the people leave the money inside the corporation, but as a result, you have lots of retained earnings in the corporation. Now you want to use the corporation money to buy a primary house. The strategy I have is, why don't you sell your house to basically corporation? What does that mean? If you want to buy a bigger house, you can technically sell your existing property, which you live in, to your corporation. Because you're selling it to a corporation and it is your principal residence, your tax rate is 0 because principal residence. But now you are able to get money from the corporation because you sold it to the corporation. So step by step, you had an existing house and you wanted to move to a bigger house. So you sold your house to a corporation. When you sold your house to a corporation, the corporation needs to pay you. When it pays you, the money comes to you and you're able to withdraw all of the money from the corporation. When the money comes to you, you can buy a bigger house or whatever you want to do. And because in the transaction, you were selling your principal residence to the corporation, any capital gain is tax exempt because, you sold your principal residence exemption, right? Do keep in mind, there is a land transfer that is triggered from this. But in this scenario, you're able to use the corporation's money to buy and use to basically get a new house. Now, when you buy a new house, you can refinance it, take out more equity and, continue your game. But those are the 4 strategies that I wanted to touch base today. Once again, thank you guys for joining in. We'll take up questions now. Keep in mind, I do these sessions every Tuesday at 2 p.m. So if you have missed this one, if you want a recording or if you wanted the PowerPoint, you can email me and I'll certainly be able to share that with you. Thank you.
So Lakshya, I have one question.
Go ahead.
Residence to the corporation, but when the primary residence was bought, was not under the corporation, but you can still sell it?
Yeah. So if Kulsum bought a house and she, owns the house and she wants to move to a bigger house, but all of her money is stuck in corporation, she can basically sell her house to the corporation and the corporation needs to pay her now. And all of the corporation that was tied or stuck in the corporation will come to Kulsum now.
But what corporation money is, if I will be buying the house from the corporation, can I sell it also through the corporation, the same house?
Yeah.
Okay. At the same time?
Yeah.
Okay. Got it.
Go ahead, Devinder.
Yeah. So can you go on the back slide?
Slide 1.
Yeah, no, that's fine. From here. So the bigger house we want to buy, so we have some money in our corporation, but how corporation can pay our current house money? Because we have maybe $500,000 sitting over there. Mm-hmm. But my house value is around 5.5 million.
Okay.
Maybe 1.5 million. Yeah.
Mm-hmm. So basically, corporation will pay you whatever the money it is having in the corporation to you. And then remainder of it will be financed through a mortgage through the bank, just like you would any other way.
So that means corporation is going to get that mortgage.
Correct.
Because we sold to the corporation.
Correct.
Okay, a little bit technical this one. Okay, yeah, go on first slide.
Yeah.
Okay, so for the regular car, so maximum we can do $30,000 for the.
So what it does is CRA says that for business purposes, you cannot be buying luxury vehicles. So they're saying is regardless of however much the cost of the car is, the first 30,000, we will give you an accelerated rate of 30% depreciation every year. Any cost above the 30,000, we still give you depreciation, but less than 30% per year.
So how we can put as a in our financial statement? So like maybe it's a $60,000 car. So 30,000 we can put as high depreciation. What about the remaining 30,000?
So basically tax software automatically, you will enter the full amount, but what it does, it behind the scenes, it breaks it into two different depreciation models. It basically tracks the depreciation separately.
Okay.
It's a bit technical because like if you're an accountant, maybe, and you've prepared taxes, only then you'll be able to see this.
Okay. So, but we have to put 60,000.
Correct. Full amount.
Full amount. If not, if we missed last year, or is there any possibility we can put now?
You can amend the tax return, but there's cost and benefit. You wouldn't want to amend a tax return unless it's absolutely.
Okay. So yeah, please go to the next slide. So just want to see. So business tax rate is 12.2%. This is, I think, up to $500,000.
Correct.
So if it's more than $500,000, how it will work?
26%.
26% flat?
Yeah.
So although it's a 500,000, maybe 1,000 above, so it was flat 26,000.
Correct.
Okay. If we get a gain from the in a corporation, how that will be taxed?
A gain? What do you mean?
Gain, capital gain.
Same as like regular income, 50% taxes.
So in a corporation, it's a 50% tax.
Yeah, just like you would get taxed personally.
So no. That is, I understand. So that means if I get a gain of say $1 million, so 500,000 will be taxed.
No, 50% of the gain would be taxed. So just like, $500,000 is the gain, 50% of this is taxable, gets added to your personal income.
Yes, but that capital gain was done in a corporation, not personal level. So that 250,000 at what rate that will be taxed?
50%, once again. It's the exact same. The difference buying in a capital gains in a corporation versus a capital gain under personal level is the exact same.
Okay. So now my question is a little different. My question is 50% of the amount is a capital gain. Say 500,000 I got a gain. So 250,000, that is 50%. That will tax as a normal tax rate.
Correct.
So in a corporation, so that tax will be 12.3%, or no, it will be different in a capital gain case?
50%. The tax rate is actually 50%, not the 12.2%. Because capital gain is considered investment income under corporation. Investment income has a different tax rate than a tax rate for business income. Business income is considered any active business income that you do. When you're making a capital gain, that's once off. So they consider it as an investment income. Investment income does not get taxed at 12.2.
Okay. So that means
we're going to confuse everyone in this slideshow.
No.
Let's try to keep this session. Let's try to keep the questions a little bit less accounting and more generic.
Yeah, Lakshya, attender on this side. I just have one question regarding this electric vehicle. Okay. So as per you, we need to purchase the vehicle. In case we take it on a lease, then any benefits are available, or how we can?
Yeah. So basically, if you lease it, then you can only subtract the cost of the lease monthly. Then you don't do depreciation.
Okay. That is full amount of lease.
Yes. So I recently bought the car, and the reason why I was forced to buy is because the lease rate was like 8%, 7.99% interest, whereas the finance rate was 5%. So I had no choice but to go with the lower interest rate option and finance the car.
Okay.
So if you finance the car, you depreciate it a lot more. So I can write off $59,000 worth of depreciation in 1 year.
In 1 year only.
So Lakshya, I have a question over here. So this maybe we can spread in 2 years or 3 years also?
If you don't want to, yes, you can.
Okay.
So Lakshya, what's the meaning of phased out in 2028? And you said also 2024.
So basically this incentive has a cap on it because government is funding this incentive, right? So they're saying is 2024 onwards, we will basically reduce the amount of claims that can be done. So 2024 onwards, they will start denying these ones. And then 2028 onwards, it's completely off the table. It's gone.
Okay, got it. Thank you.
Yeah.
Hey, Lakshay. This is Meet. Hi, how are you?
Good.
This is a good sessions. A lot of information. Thank you for this one. I have electric vehicle. Sorry, I got disconnected. So my question is, if the price is more than 60,000, which you said we can write off 60,000, right?
Mm-hmm.
What we can do in that case?
If the cost is more than 59,000 plus HST, you will still be allowed to write off maximum of 59,000 in 1 year. The remainder can be depreciated in the following year.
Okay, got it.
Yeah, Lakshya, like this is regarding electrical vehicle again. Like suppose if I have a annual income of $400,000, and this 59,000, as you mentioned in the slide, it will be deducted from 400,000, or we need to first apply tax?
No, 400,000.
Okay, so from 400,000 we subtract 59,000.
Correct, 60,000. So you'll be paying taxes on
the balance.
341.
Okay, 341. Okay, thank you.
So on a vendor take back, say like I'm giving $500,000, although I sold for $1 million. So I'm going to show CRA I sold for $500,000.
No, you will be doing the whole amount and then filing an election saying that you want to spread out your capital gains for the remainder of the 5 years because you haven't received the money fully.
Okay. If vendor take back is normally like I can give to someone on maybe 5% interest rate, principal and interest mixed, then like every year maybe I'm getting $20,000. So I'm going to pay tax accordingly.
Yeah.
Okay.
So interest will be taxed separately. Again, passive income, 50% taxes.
Right.
Okay. Any more questions? We have 1 minute left.
Lakshay, your electric vehicle slide hit the roof, Now we are all going to be buying electrical vehicles.
Yeah, this 2022 onwards, it's became 59,000. It used to be 55,000. So they increased it by another 4,000.
So one vehicle should be in the business, should be electrical.
Yeah, maybe Tesla should write me a check.
Yeah. Okay. No, but the session was really great. Thank you so much for this session,
Thank you very much. Appreciate everyone joining in. For any more questions, you guys can reach out to me at my, phone number and my email address on the screen. If there are no more questions, I would like to wrap this off.